Thank you so much for having me. Let's talk about what dominates headlines today in terms of risks, things we worry about, things we wake up with a cold sweat in the middle of the night thinking about. Climate change is one big issue. General environmental degradation. Many people say, for example, that the water crisis is even more serious than global warming, is another one. Rising inequality, not across countries, but within countries, is something that we see. The numbers are very clear on that, particularly since Lehman Crash. And it is starting to really affect our lives in terms of the response to this rising inequality, particularly within the OECD. In that sense, rising populism exactly also is an issue that we are grappling with increasingly, particularly in Europe and in the United States. So what is, if any, the common thread across most of these problems that we grapple with? What is this elephant in the room that connects these? And my answer to this is it's actually the financial system. The financial system would like to think it is very complicated, and I remember the pre-Lehman days where anytime you talk to a banker, they would talk about finance as rocket science. And it was the best way to stop people discussing how finance actually worked. I mean, it is nothing like rocket science. Perhaps a more fitting analogy, sticking with elephants, is it's been the case of the 5 blind men and the elephant, where everybody, be it us as retail customers of banks, or pension holders putting money in their pension funds, or financial regulators, central banks overseeing certain aspects of the financial system, etc., or as a company or an entrepreneur trying to raise money, we all saw various parts of the elephant. Somebody saw the tail and thought it was a rope. Somebody felt the leg and thought it was a pillar. But frankly, there wasn't really much of an incentive for anybody to really understand how the financial system as a whole worked. Of course, that has all changed with Lehman. So where does that leave us? And what can we do to make sure that the financial system, which has been functioning rather poorly in the past few decades and has indirectly or directly in some cases given rise to these major problems that we grapple with, how can we deploy it in our service? That's basically what I'm going to try and talk about. Now, it is helpful to avoid jargon. It is helpful to avoid big fancy words the financial community likes to use. So let's try and perhaps think of finance as a traffic system. Well, it's not too different in terms of the basic function it performs. So there's many people who will say finance is like the brain of the economy, in the sense that it is actually the financial system which attaches relative value to goods. The value of that house in London versus the stock in an Indian bank versus how much you get paid versus how much your CEO gets paid. All of these, the value ascription is directly or indirectly the result of the financial system. And very importantly, indirectly as a result of these values, finance is actually responsible for allocating resources within the economy. Right? In the same way that our brain decides whether our left hand is moving or our right leg, whether I'm running or painting, the financial system channels resources to where they ought to go. And similarly, a transport system is supposed to do the same job. It is supposed to get people from where they live to where they work. It is supposed to get you from home to school to universities. It is supposed to transport food from where it is grown, where the supply is, to where the demand is, where you live, where you eat. So finance is similarly expected to take savings and money from where there are too many, from there where return opportunities are not as attractive, to deliver that money to parts of the economy, to parts of the world where there is a shortage of capital, where the return on that capital can actually be significantly higher. So let's stick with this analogy for a second. Now, it's not that we had the good old days where everything worked perfectly, but what we did have was a reasonably well-functioning financial system. In terms of the traffic, what you had was you had cars, you had trucks, you had public transport systems, you had buses, you had railroads, you had people walking, people on bicycles, and it was pretty well regulated, the traffic system. You had a lot of speed bumps, speed limits were very strictly enforced, there were a lot of traffic cops, there were traffic cameras, there were barriers, pedestrian zones where you couldn't go, cycle lanes. And that sort of system was, if you look at any of the clips from the 1970s and 80s, you see rather slow-moving traffic, and you see roads that are not that congested, and you see what looks like a rather benign looking traffic system. Finance was not much different. There were banks, mostly your local neighborhood banks, some were regional, there were a few big giants, there were some pension funds, there were some insurers, there were some advisors, some specialists, but for the most part, banking was a rather boring job. Finance was nothing particularly exciting. It was well paid, but not the kind of money that we have been seeing recently. And it was very strictly regulated. You had strict limits on what any particular institution could do or couldn't do. You had strict limits on how you could sell products to retail customers. You had limits on what pension funds could invest their money in and what they couldn't do. You had limits on cross-border flows of money. All in all, the regulators were quite powerful. They kept a close watch on everything that was going on in the financial system, and things worked reasonably well. And the fruit of those well-regulated systems were very easy to see. We saw post-World War II, particularly in the 60s and the 70s onwards, we saw fantastic growth rates. We saw poverty reduction. We saw great creation of new jobs. We saw falling inequality, and we saw what was generally a well-functioning economic system that was partly driven by a financial system that did its job relatively well. But that started to change. It's hard to pinpoint when, but perhaps Maggie Thatcher's and Ronald Reagan's deregulation era starting in the 80s was a good starting point. So over time, these cars that were being driven gently became SUVs. The trucks that you saw, the 6-wheelers, became the 16-wheelers and the 32-wheelers. Some of them became oil tankers and started carrying dangerous products. Some oil tankers started carrying hazardous chemicals, radioactive waste perhaps. Some people call these derivative products, many of which, as Warren Buffett has said, and I used to trade some of them, were actually toxic. The second thing that happened was the speed limits were slowly abolished. The traffic cops that were employed were relatively well paid compared to the drivers driving these financial institutions. I'm talking about financial regulators, of course. They started getting fired, or their relative compensation fell behind. So it became more and more attractive not to be a regulator, but actually to be a banker. The other developments, of course, were that the drivers started racing with each other because speed limits have been abolished. So this was one bank competing with the other, trying to generate faster profits, the stock markets encouraging them on the basis of quarterly stock market returns. Big bonuses were on offer, so all of the drivers could earn, in theory, bonuses that were 10 times their base compensation. Such bonuses were simply not available in the good old days. Now, this incentivized everybody to drive even faster and crazier. And remember, they are no longer driving relatively small cars or benign trucks, but they're driving big fuel tankers at breakneck speeds, careening down the road, while the regulators and the police that were supposed to keep guard have fewer and fewer resources. The traffic cameras that existed were spray painted over because one of the characteristics of derivative products is that they're very, very opaque. And many derivative products were traded using offshore tax haven subsidiaries. Lehman Brothers, the institution I used to work for, had more than 300 subsidiaries. And these tax haven subsidiaries were completely out of view for regulators. So it was Russian doll-like secrecy. So it was really not clear. It became less and less visible to regulators or to traffic cops in the traffic system what was actually going on. No doubt, no wonder, under such a circumstance, that a truck crashed. And this truck happened to be called Lehman Brothers. And it was loaded with toxic products. And at the same time that the truck crashed, there was a descent of San Francisco fog on the traffic system. So at that point, the first assumption for everybody is that, hey, I'm not really sure whether this was carrying radioactive waste or was it sarin gas or some toxic product, but that's out on the road. Lehman's carcass is lying on the road and there's toxic fumes. I don't think I should go driving today. The second thing was Lehman crashed while racing Goldman and Morgan Stanley. And the second logical thing for me to think was, oh my God, do Goldman and Morgan Stanley also have that toxic waste? And will they crash too? So it made complete rational sense, given this level of uncertainty where everybody's logically assumed the worst possible case, for everybody to stay at home and stop driving. And of course, when finance stops working, when finance stops flowing, the whole economy comes to a standstill. This is exactly what happens in the event of a traffic jam. This is what happens whenever there's a big crash on the motorway. And this is what happens whenever there's a strike. But similarly, that's exactly what happened. And we need to make sure that this doesn't happen again. So it's not that finance has not crashed before. This was something along the lines of the 90th financial crisis we have seen. Similarly, traffic crashes happen all the time. Every single day, a truck or a car crashes. Occasionally, a plane falls. And once in a while, there's a train crash. But what has changed is within the financial system, over time, the frequency of these crashes has increased. How dangerous they are for the economy has become far more pernicious. And this has something to do with the size of the institutions, the size of these trucks, the nature of the products that they sell or they are carrying, the irresponsibility of the drivers at the helm of it, and the poor resources of those who can enforce disciplined behavior. So this cannot continue. Now the question is, what can be done, what has been done, what is being done to help reform the financial system in a way that it does actually start, once again, reducing inequality, tackling climate change perhaps in the same way that it has successfully in the past tackled problems of food shortage, for example, and act in a way where crashes are less frequent and less dangerous for society. Well, let's stick with the traffic system analogy. A number of lessons can be used from that same traffic system. So the first one is the actual nature of the vehicles. It is important, you've presumably all heard the words too big to fail or systemically significant financial institutions. These are technical words for what within the traffic system are dangerous, fast-moving trucks carrying hazardous chemicals. There are financial institutions that are so big, so powerful, and trade so fast across borders that anytime something goes wrong with them, that has consequences across the financial system. So very tightly regulating the behavior of these hazardous chemical trucks called CFIs or too big to fail institutions is the first sensible way to go forward. And one starting point perhaps is to make sure that maybe the 32-wheeler trucks should be shrunk down to the 16-wheel trucks. Maybe instead of having a speed limit of 80 kilometers per hour, it should be reduced to 40 kilometers per hour. Maybe instead of having the normal licensing regime for the driver at the helm of these institutions, they should be made to undergo rigorous additional tests to make sure that they drive responsibly. Perhaps rather than having these institutions checked every year, as they are, if you ever drive a car, you know that every year you have to check that the car is roadworthy, and that is the only way you are allowed to drive. Similarly, for financial institutions, every year they are subject to stress tests, but maybe these tests need to be made more stringent. So that is one way to go forward, to change the nature of the vehicles on the road, to change the nature of financial institutions that exist, to make them smaller and to make them more different. One part of the problem has been that more and more institutions have become similar to each other, which means when one crashes, everybody else reacts exactly in the same way, and it leads to a huge traffic pileup. The second important lesson that can be learned from the traffic regime is to make sure that there is a separate bicycle lane, to expand the pedestrian zones, to have a separate lane for buses and taxis and public transport, and to make sure that the barriers between these are not crisscrossed over. Again, one of the consequences of the deregulation unleashed by Thatcher and Reagan was that institutions essentially started behaving in any way that they wanted. The same institutions which were forbidden from at the same time trading in derivative markets as selling to you and I and the little people and their savings products were allowed to do both at the same time, which led to massive conflicts of interest. So keeping and reenacting these boundaries is a good disciplining way to make sure that the traffic system as a whole, that the financial system as a whole does its job, and there isn't a massive conflict of interest, and that each different part of the economy gets serviced by the kind of financial institution that is appropriate to it. That we do not have what we saw, which was savings banks all wanted to be like Goldman Sachs. Goldman Sachs wanted to be like a hedge fund. And we ended up in a situation where everybody suffered.